Hello and assalamu alaikum everyone. In our previous lecture, we talked about cash flow forecasting, how do we use cash flow forecasting, and we saw some questions that can come in our exams. So now let's look at the ways how can we improve our cash flows. Now earlier we saw there were some times where you had a negative closing balance. There were times when you had a positive closing balance. Now one ideal situation will be when your inflows are greater than your outflows, or even if they are not 1-2 times, it's okay. The main Your main concern is that you should have enough cash to cover up your expenses so that your closing balance is positive. Okay, that's what the businesses want. As you have seen in previous cash flow forecast as well, that's not always the case. 1-2 months at least you have to pay. Your closing balance is negative at times because of high cash outflows, or perhaps less cash inflows. So we're going to look at how can we improve that. Okay, we want to improve our cash flow forecast. We want to have the maximum amount of cash possible at a certain time. Like, we want to increase our cash inflows or either decrease our cash outflows. Those Either of those ways we can have a better cash flows. So in today's lecture we're going to talk about how we can increase our cash inflows, and the next lecture we're going to talk about decreasing cash outflows. So let's look at some methods for increasing cash inflows. Additional promotion could be undertaken. This would, however, cause a high initial cash outflow, but the rewards from increased sales might more than compensate for it. So, of course, if you increase your promotion, it is likely, not a guarantee, but it is likely that your sales will increase as your product will be promoted to a greater consumer market. More consumers will be aware of the product, or perhaps they're reminded of the product. Okay, there is this product, this exists, or it has some better features or something. Okay, so promotion helps you to get a greater increase your sales, and when you have increased sales you could have increased out inflows. However, a business might have negative cash flow and therefore not able to afford it. Okay, so it is of course not too much of a too cheap. It's generally expensive, so not all businesses can afford it, especially if you have a negative cash flow. Furthermore, the additional sales made due to additional promotion should be made for cash rather than credit. Okay, so whatever the increase in sales that you want them to be cash sales, not credit sales, because if they are credit sales, then that means again you don't have enough cash, you have to wait for cash. So only then will it be effective option for increasing cash inflows, when you have cash sales. So you would want to have additional promotion so that you can increase your cash sales. So that's one of the methods that you can use for increasing your cash inflows, but that's not much of an effective method, I would say, when we'll see, and you understand why as we look at other methods. Okay, so another method is reducing the credit period given to customers for credit purchases, that is managing your trade receivables. So some in this particular point we are going to talk about how we can manage your credit sales. Okay, we want to reduce the credit term, or perhaps just completely discontinue it. But let's look at that. Using this method, a business can get its payment early. Why? We can just say, okay, instead of 1 month, I want you to pay the payment in half month, let's say 2 weeks. So the customers now have to pay in 2 weeks for credit sales instead of 1 month. So you will have the cash in 2 weeks only. So you get cash earlier. However, customers usually expect some credit and may go to competitors if they don't get their required or desired credit term. So there is a certain, you don't want to be too stringent, or like, okay, I'm just reducing it a lot, and customers are like, no, I want this much. If you reduce that credit term more, I won't have more business with you, I'll just go to competitor. So that's some competition you have to look out for. Okay, so you just won't want that to happen. You want to reduce your credit term, but not that much that your customers actually leave your business. Okay, you don't want that. It is a difficult option for new or small businesses, as they need to give more credit term to compete against other big firms and secure a good customer base. So instead, what you could do, the opportunity cost is customers. Okay, so if you increase your credit period, you will get more customers. You reduce the credit period, your customers will decrease. Okay, increase. It's a direct relationship. So you want new businesses generally want to. They have to. They don't generally want to, but they have to give more credit periods to secure a good customer base. So it may be a better option for businesses operating in a niche market or reputable business with good brand names, as they have a loyal customer base. So niche market, of course, people don't won't have any other competitors to go to, so they will agree to the short credit period. And reputable business, again, okay, it's an iPhone or big brand names, McDonald's, KFC, okay, they all have good brand names. So okay, customers can agree to that, but they won't be agreeing to small businesses or mass market businesses, okay, because there are competitors available. They can go to, they can switch brands, but they won't be able to do that in a niche market business or a good branded business. So for those particular businesses, it's a good option. For others, not so much. What should other businesses do? Let's look at other methods as well. There are short-term loans that can also offer quick cash inflows. However, most small businesses don't have enough assets to offer as collateral for secured loans, and hence may take unsecured loans instead. So far what we have said, that not all mostly small businesses, in turn, they don't have enough assets to offer as collateral, so they have to take unsecured loans, which have a higher rate of interest, of course. So that means, okay, perhaps you now have a good cash inflow because of loans, but because of this loan that you have taken, this higher rate of interest, there might be a greater cash outflow when you don't want that. Okay, you don't want enough greater cash outflow, that because if your cash outflow increase and you don't have enough inflows, you don't have enough opening balance, that means your closing balance is negative. Okay, you want to take loans, okay, to increase your cash inflows, but at such times that, okay, I take loan in month 1 where my sales are low, okay, but in month 4 my sales will be high enough, so at that time I will be able to repay back the loan. But if the loan needs to be repaid in month 3, then that becomes a problem. Or perhaps if it's to be repaid in month 4 only, but the rate of interest is so high that the loan cost in the overall outflows overweights the inflows, so that becomes a problem. Okay, and taking loans is also difficult if the gearing, that is an A2 term gearing, okay, that is basically, for now you can say, the existing debts. Okay, you don't need to know much more detail about that. So taking loans is difficult if the gearing, that is the existing debts on a business, is already high. So if you already have high debts, you already have debts, then banks won't give you more debts. Okay, you need to first cover up those debts in order to take more loans. So this option is again not too good of an option because it's not available to small businesses and those businesses which have a high gearing. It's only available if you don't have enough, you have low gearing, and you are you have enough reputation, enough, you're confident enough that, okay, I will be able to repay back the loan with a good amount. Like, you want secured loans, you don't want unsecured loans, because then again they will add to your costs. Then let's look at other methods now. Approach banks for extended overdraft. Now overdraft is again similar to loans, but it is that it can be arranged quickly and sometimes doesn't require collateral for small overdrafts, so that's a good thing for small businesses. Therefore it is a good option when business needs a quick and a medium high amount of cash. Okay, you need cash quickly, and the amount of cash is a medium or high amount. Okay, so it's like more than the loans, that more amount of cash that the loans can offer. However, it's expensive due to higher rates of interest. Okay, you might not have to offer collateral or sometimes, but there is a high rate of interest than traditional loans, so may result in greater cash outflow later. Furthermore, overdrafts can be called off anytime, so they are not always reliable. Okay, so you have to see more about the benefits and drawbacks of overdrafts for managing cash flow, which we have discussed in chapter 4.2, sources of finance. So you can mention that, look at that to elaborate more on this point. Another option for increasing our sales are sale of idle or underutilized assets. So this is one of my favorite methods compared to the previous ones. Why is that? Because, as I'll explain, that sale of idle or underutilized assets can also be used to increase cash inflows. However, The assets might have to be sold at a lower price if sold quickly, or perhaps if they are old, outdated, or obsolete. So, if that's the case, then you might not have enough of cash by selling that asset as well. Another drawback is that assets may be required later if the business expands. Okay, so if the business expands, now you don't want an asset now, but after expansion you want that asset back, but you can't. Perhaps that price has increased, so you should have taken that asset. You should not have sold that asset at that time, but you will regret that later. So you don't want that. Okay, you only want to. So these are the two drawbacks. Okay, either you won't have enough good price for that asset, and you might need it later. So, you know to counter this, a business can sell its assets to a leasing company and lease them back instead. Now this is one of the better options. In this, instead of just directly selling the assets, underutilized assets, you can lease it back if you want to use it again. Okay, if it's not like completely idle, you still want to use it. So in this way, the business will have quick cash inflow from selling the asset. Okay, once it sells the asset, it has a good amount. Okay, and small cash outflows from leasing it. Okay, so let's say that you sold an asset for $500. Okay, and you lease it, that is, you perhaps renting it. Okay, leasing is same as renting. So $500 you sold it for, and each month you have to pay $30 to use it. So that way, okay, you have a good inflow and you're having small outflow. So that's a good thing, an ideal situation. It perhaps maybe lead at a lower rate as well, since this asset was sold by the business to the leasing company. Perhaps if you have a similar asset from leasing company, if you ask for a leasing company for that asset, similar asset, they might say it's $50 per month. But since you sold them to that business, they are saying, okay, you can have that for $40, $45. Okay, they have lowered the rate for you. So assets could have been used as collateral for secured loans. This is one disadvantage with this method. Okay, so even if you can sell assets and lease it back, it's a very good thing, but still it has its own drawback that it could have been used as collateral for secured loans. That is, sale of idle assets rather than offering it as a collateral for bank loans is a better option if the gearing in business is higher. So, okay, you have two options over here. Either you sell your assets and lease it back, so you will have good inflows and less outflows, or you can either use that asset to offer as collateral to a bank. Okay, you offer that to a bank for a collateral and get secured loans instead. So you can either get loans or you can get leasing, whichever works for you. So generally you will prefer selling your idle assets instead of offering it as collateral to business if your gearing is already high, that is, you already have high existing debts. Finally, we have debt factoring. Now we don't have enough time to cover debt factoring right now, so I'll cover that in the next video. Okay, so thanks for watching, and Allah Hafiz.